The stock market started out the month of September very strong by posting new all-time highs, but since then, it's been dipping. If your stock portfolio has been declining, I personally think you shouldn't worry because I truly believe this is an opportunity to buy some of the best stocks at a discount. What is going on, Moon Gang? Welcome back. My name is Matt, and in this video, I will be discussing 5 companies with huge growth potential that are all worth a spot on your watch list for the rest of this year and then some. Make sure you stick around until the end because I will also be sharing some of my personal opinions on the state of the overall market. If you're interested in this type of content and you want to be a member of an awesome community, join the Moon Gang by hitting the subscribe button. And don't forget to turn on your notifications so you don't miss any of the new videos. Alrighty then, let's get started. The first 2 stocks I'll be discussing are technology companies that have been massive beneficiaries of the new stay-at-home economy. The first is Shopify, which is an e-commerce platform that makes it extremely easy to build an online business. As you can imagine, e-commerce has grown exponentially this year, and Shopify was well positioned to ride the wave. From the start of 2020 until now, Shopify is up 130%. Over the past 6 months, it's up 116%, and over the past month, it's down just under 6%. From 2015 until 2019, Shopify's total revenues grew at a considerable rate from $200 million to $1.6 billion, and over the past 12 months, their total revenues sits at an incredible $2 billion. Their gross profit has also grown tenfold from $100 million to $1.1 billion. Many investors think that Shopify is overpriced and is trading at a premium because it's currently operating at a loss of $67 million. But honestly, that doesn't really bother me because Shopify is continually growing and they're already a dominant player in the e-commerce sector, which has become an integral part of our society. According to Wall Street analysts, out of 32 polled, 11 have a buy rating and 2 are saying outperform. At the time I'm making this video, Shopify is trading at $914, and over the next 12 months, they have a median price target of $1,150 with a high price target of $1,400. I would never recommend that you arbitrarily buy a stock. Beyond doing your own research, you should attempt to buy as close to support as possible because it helps optimize your risk to reward. Shopify trades under the ticker SHOP, and the first support is pretty close by at 883. Below that would be the high from May at 842, and as a reach target, you could watch 780. I personally don't own any shares of Shopify at the moment, but I will be watching closely to see how it reacts to these levels of support because I think the e-commerce sector in general has a bright future. The second stock on this list is Square. This company offers wildly popular payment systems and is expanding into e-commerce. In fact, Square is creating a really cool ecosystem of merchant services. From the start of 2020 until now, Square is up 119%. Over the past 6 months, it's up 120%. And over the past 1 month, it's down 0.6%. Square's income statement screams growth. In 2015, their total revenues was $1.2 billion, and now it's all the way up to just under $6 billion. And their gross profit has exploded from $375 million to $2.1 billion. To make things even better, Square has recently become a profitable company. As recent as 2018, they were operating in the red, but now they have a profit of over $300 million. Out of 42 Wall Street analysts, 17 are saying buy and 1 is saying outperform. At the time I'm making this video, Square is trading at $137 and the median target over the next 12 months is $160 and the high target is $265, which is a 93% upside. Square trades under the ticker SQ, and since the start of September, the stock has taken a 19% hit. In fact, the first support level of 134 has now been tested on 4 separate occasions. If the bears push the stock below this, I would then be paying attention to 117, and then this would be followed from the low in July at 111. Unlike Shopify, I do currently own shares of Square, and my average cost is roughly $127. If the stock is pushed to either of these bottom two support levels, I would be happy to add to my position because, as I said before, I think the e-commerce sector has a bright future. The third stock on this list is the online sports betting company DraftKings. The reason why I put DraftKings on this list is pretty simple. I think online gambling is about to explode. As you can see from this picture, DraftKings is currently sanctioned in 8 different states. Imagine how big the company will get when it's allowed in all 50 states. In this calendar year, DraftKings is currently up 288%. Over the past 6 months, they're up 233%, and over the past 1 month, they're up just under 30%. As online sports betting has become legal in more and more states, DraftKings as a company has grown. In 2017, their total revenues was $192 million, and now it's all the way up at $357 million, and in the same time frame, their gross profit has gone from $160 million to $202 million. DraftKings is currently operating at a loss, but that doesn't really bother me because it's only allowed in 8 states. As DraftKings expands throughout the US, I'm fully expecting the company and its stock to explode. Out of a group of 15 analysts, 10 give DraftKings a buy rating. At the time I'm making this video, the stock is trading just above $41, and over the next 12 months, the median price target is $49 and the high price target is $60. DraftKings trades under the ticker DKNG, and it's had a pretty impressive year. In March, it was trading as low as $11, and now it's up at $41, which isn't too far off from the all-time high just below $45. From a technical perspective, it looks like a cup and handle pattern could be forming, and in terms of levels of support, the first one I would be watching would come just below $39. If you think this particular support is too close and the stock could go lower, I would recommend watching 35.4, and if the stock is pushed below that, I would recommend watching the low from August at 30.5. The fourth stock on this list is Penn National Gaming. This company owns 41 gaming and racing properties in 19 states, but I think their best asset is Barstool Sports. Barstool is a dominant sports company that offers hilarious commentary on many things going on in the world, and I think they're about to become more dominant because it was recently announced that they're opening a sportsbook in Pennsylvania, which will be a huge benefit to Penn National Gaming. From January of 2020 until September, Penn is up 131%. Over the past 6 months, it's up almost 200%, and over the past 1 month, it's up a notable 27%. As you can see here, Penn is a much larger company than DraftKings. Their total revenues have gone from $2.8 billion to $4.1 billion, and their gross profit has grown from $1.2 billion to $1.8 billion. Similar to Shopify and DraftKings, Penn is currently operating at a loss, but if there's one thing I've learned about gambling, it's to not bet against the house. Jokes aside though, Penn is currently operating at a loss because casinos were shut down for a majority of the year, which is another reason why Barstool, an online company, was a great acquisition. Out of 15 analysts, 10 currently have a buy rating on Penn, which is currently trading at $59. Over the next 12 months, the median target is $55 and the high target is $80. You have to keep in mind that these forecasts are very Rona specific. The earlier that the world opens back up, these targets would be shifted higher. Penn National Gaming trades under the ticker PENN, and it's also had a very impressive year. In March, it was down at $4, and now it's all the way up at $59 after making a new all-time high just below $66. From a technical perspective, the first support would come at $51, and the next one would be kind of far away at $39, which has served as resistance on 3 separate occasions. As of now, I don't own any shares of Penn or DraftKings, but I really think sports betting is about to explode within the US, so I would be happy to buy either of these companies at levels of support. The last stock on this list is the fan favorite electric delivery van company, Workhorse. Workhorse has been a hot topic this summer because the EV sector has been booming, and on top of that, this specific company is in the running for a $6.3 billion contract with the US Postal Service, and as a quick reminder, the winner of that contract is expected to be announced in September. From the start of 2020 until now, Workhorse is up a jaw-dropping 680%. Over the past 6 months, it's up almost 1,000%, and over the past 1 month, it's up 55%. As you can see from Workhorse's total revenues, gross profit, and net income, it's a pretty small company. This means if Workhorse wins the USPS contract, which I really think they will, its stock could easily sail past $40. Out of 5 analysts, 4 rated Workhorse as a buy. Its stock is currently trading at $23, and over the next 12 months, the median target is 24.5 and the high target is 27. Workhorse trades under the ticker WKHS, and similar to Penn, it just posted a brand new high. As things currently stand, the first level of support would come at the previous high from early July at 22.9, but I would suggest paying more attention to the next level of support just below 20. If the stock is pushed below this, you could always watch 15.5, but if I'm being honest, I think there's a decent chance that the stock never trades at this bottom level again. At the time I'm making this video, I do own shares of Workhorse that I bought when the stock broke above this blue trend line. As I quickly mentioned before, I personally think that $40 is a very realistic target for Workhorse. But with that being said, Workhorse is well positioned within the EV sector, so I would be more than happy to hold my shares for years to come. Now that I've discussed 5 of the top companies that I'm personally watching with huge growth potential, I want to share something that I've noticed in 2 of the major indices. On the screen now is the daily chart for the S&P 500. It has been caught in an upward channel since April, and this technical structure is referred to as a bear channel. And as you can see, the story is very similar with the NASDAQ 100. Both indices have now closed below their respective channel for the 3rd time. This is commonly a bearish signal. Now, I'm in no way calling for a doomsday. It's just something I wanted to bring to your attention so you can move forward with proper risk management. The list of stocks I covered in this video are in no way extensive. There's a lot of opportunity across the market right now. With that being said, I would love to know your opinion on the companies I discussed in this video and whatever you think the best current opportunity is. Feel free to leave a comment below. Thanks for watching to this point in the video. I truly appreciate your support. If you have any suggestions for what I should cover next, or even any recommendations for improved lighting, audio, or overall presentation style, please don't hesitate to reach out to me. If you enjoyed the video, let me know by hitting the like button. And if you want to join the Moon Gang, subscribe to the channel and don't forget to turn on your notifications. Thanks for the support, and until next time, best of luck in the markets.